here is TSP, Thrift Savings Plan. Oops. So the TSP is the federal version of a 401k. It was started in 1986. There is a little bit over $845 billion in deposits in it, and a little over 7 million plan participants. The deposit money is managed by BlackRock for the most part, and about 10% of it is managed by a company called State Street. Now, BlackRock is the largest money manager in the United States, and mainly because of the money that they manage for the federal government. However, they do also manage a lot of mutual funds and pensions and other endowments as well. But they are very, very large. And so TSP, the amount you're allowed to defer does change every year. It goes up a little bit every year. So for 2024, the salary deferral amount is $23,000. And if you're age 50 or older, there's actually what's called a catch-up provision that allows you to put in an additional $7,500 for a total of $30,500 that you're allowed to defer into the plan. Now, your standard election on TSP is pre-tax contributions. You would this is the standard option. You'll hear it referred to potentially as traditional TSP, and so it's pre-tax money. So your money goes in before taxes are ever removed from it, and it grows tax deferred until you physically go to take the money out of TSP and receive it in your checking or savings account in retirement. At which point, only when it's received in your checking or savings account is it going to be taxed. So very important to note that. It has no impact on your Social Security withholding. The salary deferral you elect, if you elect a percentage, is off of your base pay and locality pay combo, and it's paid out of payroll deduction. Now, the way it works is when you start, the federal government is going to automatically give you a 1% contribution on your behalf going into the plan, and you're fully vested in that after 3 years of being in the plan. They also will auto enroll you at 5% of contribution. Now, you can opt into a different amount if you want. You can go higher, you can go lower, but the auto enrollment now is 5%. It wasn't always that way. It used to be 3%, but it's now 5. Now, the way they match on that is they do dollar for dollar on the first 3% of contributions you have going in, and then 50 cents on the dollar for the next 2%. So essentially, what happens is you put in 5%, you're going to get 5% that's made up of 3 from here, plus another 1, plus this one to get you the 5. So 5 gets you 5. Now, you can certainly contribute more than 5%. There's just not going to be a match on the amounts over that 5%. TSP also offers a Roth option. So Roth is after tax dollars. So they tax the earnings and then the money goes into the Roth TSP. It is subject to the same limits. You can do 23,000 plus the catch-up provision for 2024. The advantages of this is once it's in the Roth side, because it's now taxed income that went in there, or tax contributions already this is going in there, they grow tax deferred all the way up until retirement. And once you retire or over 59 and a half, every penny you take out of this is going to be tax free. The only provision is that you have to have the Roth side open for at least 5 years. So you can't do this in, say, your last year of employment and then try to take the money out right away. It does have to have kind of been sitting in there for 5 years. But other than that 5-year window, every penny you take out of it is tax free in retirement to you. And so what constitutes your salary? Again, it's base pay plus locality pay. So when you elect that percentage, that's what they're going to withhold from. And whether you should do the pre-tax traditional or the post-tax Roth IRA side, that is going to depend on you as an individual, and everybody's circumstances is different. I definitely suggest you consult with us, a financial planner, maybe your tax advisor, to figure out which one is kind of the best interest for you. The one thing I will add on the Roth TSP side is it is different than a Roth IRA. So Roth IRAs have much lower annual limits. You believe it's about $8,000 for this year. But they also have earnings caps. So if you make over a certain amount of money, you're not even eligible to do the TSP IRA. I'm sorry, the Roth IRA. TSP Roth is not subject to earning caps and it has much, much higher contribution limits. So it is a very, very powerful vehicle. Um, but again, these are not a one size fits all types, scenario. You definitely want to talk to somebody on which one's best for you in your particular situation. Um, Basically, participation in TSP is immediate. It starts when you're hired. Um, it says here you complete your a TSP1 form. It's part of your hire packet or you know promotion to full time packet. Um, I've talked about percentages. You can also elect to do a flat salary amount. So if you wanted to do like $100 a pay, you can do that instead if you want. I will say that one strategy that so so TSP has a lot of TSP millionaires. In fact, 2023, um, at the end of 2023, it was the highest amount of TSP millionaires they've ever had. I've seen folks that have several $1 million in their TSP. And generally, when I've talked to these folks and meeting with them, I find that the way they generally get there is they started early in saving, and they started out usually kind of getting as much as they could up to the match, right? At least doing the 5%. Now, beyond that, every time they would get a pay increase, whether it's a COLA adjustment, a step or grade increase, any of those things, they would bump up that contribution 1% or so. And the idea being that the promotion or the step increase are usually more than 1%. So you're still getting an increase in your bring home, but you're also increasing how much you're deferring. So you get a little bit of immediate satisfaction from it, but you're also getting delayed satisfaction in more money going in from your retirement. If you do that every time you get a pay increase or cost of living adjustment, eventually you're going to be maxing out how much you can put in TSP. And when you're doing that, you'll find that your TSP balance will grow very rapidly over time, and you'll get to take advantage of compound interest on very large amounts of money. So something to keep in mind if you're watching this and you're kind of early in your career. Now, when you enroll, you are automatically enrolled into the L fund as your investment choice. And there's a couple of different L funds. We'll talk about those, but it's going to be L with a year following it. So the way they work, way they figure out what year follows it is again, it's based on your full age retirement. So we talked about that with Social Security earlier for a lot of you at 67. So they're going to pick that 5 year window. So they're usually like 2030, 2035, 2040. They're going to figure out which 5 year window is the closest to that age for you, and that's what you'll have. So it could be an L 2050 fund or an L 2060 fund for some of you that are watching this, then they're very early in your career. For those of you later in your career, it's probably the L25 or L2030 fund that they opted you into. So you can opt out of that though. You can go into your account at any time and make changes to your investment choices. And so this is a page on how you can contact TSP. You'll see here there are phone numbers, forms, things like that, but all of this stuff, for the most part, is available on their new website, tsp.gov. This site was overhauled about 2 years ago with significant changes. The one thing I will point out is there were some glitches in the conversion to the new site. So if you had listed beneficiaries on your TSP account prior to the conversion to the new site and haven't looked at those listed since then, you do need to go check that. A lot of the beneficiaries that were listed got dropped during the transition to the new website. So you definitely want to check on that. Perhaps list new beneficiaries there if you need to. Um, if you need to reallocate funds or anything like that, you can do it right on the site. If you need to change your contribution amount, you do need to talk to HR and get a form to do that. But otherwise, the rest of the changes and printing statements and all that type of stuff is done on the TSP website. Your TSP account balance is calculated at the end of each business day. It's going to take into account contributions, loans, any withdrawal activity, fund transfers, and any changes in the actual values of the account. And so you'll find here that the different investment options, there are 5 what I call core investment options. So we touched on the L funds a little bit a minute ago as to like which one you might have. I'll just go into depth on how they work in a second, but there's 5 core investment choices. So the first one is the G fund. Think guarantee or government. The G fund is downside protected, so you won't lose any money in the G fund, but you're also not going to make a whole lot of money. It is based on the U.S. Treasury rates, it's U.S. Treasuries that you're holding. That's thus it's safe, but think long-term gains of 1 to 2% generally is kind of the range that they're paying in there. The other four funds are the C fund, which is the S&P 500, the S fund, which is the remaining large and like mid cap, small cap U.S. companies, but they kind of make up the rest of the Dow. So they there's no overlap between the two. They're different funds, but they complement each other well. But they're U.S. companies. The I fund is international funds, and the F fund is going to be bonds. And so they're, as I mentioned, managed mostly by BlackRock, and they're designed to kind of mirror those some different indexes in those categories. They're trying to, you can see here, they're trying to meet the index, not necessarily beat the index. In fact, they won't generally beat the index. Again, the G fund, this is going to dive into each of those a little bit more specifically, but the G fund is U.S. Treasuries. Um, it's right now paying a little bit higher because Treasuries are a little bit elevated, but over time, think 1 to 2%, but it's safe money. Generally won't keep up with inflation. The F fund is the U.S. Aggregate Bond Index, and it's made up of government-backed securities, mortgage-backed, and credit-backed. These are all bonds. Generally safe, by the way, but can lose money in certain environments. We did see this drop during COVID because of rising interest rates on it. So next one here is the C fund, and this is going to be essentially the S&P 500. So the S&P 500 is the 500 largest companies across the United States. So some examples are Google, AT&T, Walmart, Coca-Cola, Amazon, Tesla, the large companies, right? So it does cover a lot of different industries, but you'll find that usually the top 7 or 8 companies make up a very large portion of the S&P 500's performance. But the total equals about 75% of the overall market. S fund is, again, it's the Dow Jones U.S. Completion Total Stock Market Index. Um, it's made up of over 3,000 medium-sized and small-sized companies. It represents about 20% of the U.S. stock market. It's diversified, but it does not overlap with the C, so it is different investments. The I fund is, again, international. It's Europe, Australasia, and Far East. It does also represent like Japan, United Kingdom, France. And there, after you can see here, after 2020, they did make some revisions to involve some other countries in this to try to get you more diversification. It's all going to be international companies. Now, the L fund, when you think L fund, you want to think it's a fund of funds. So it is made up, each L fund is made up of the 5 investment choices we just went through. The mix of those 5, so the percentages of each one you get, depends on the year behind the L. So if it's close to your retirement year, so like a L 2025 fund, then a majority of the money in there is going to be in the G fund. About 74% is in G. The remaining 20, 25, 26%, something like that, is going to be spread in the other investment choices to try to keep you basically on pace with inflation. That's their goal, is to try to get you some growth in there. If you're further out, like let's say you have the L 2060 fund, well, you're going to have very, very little G fund, maybe 1 or 2%, and the rest is all invested because your time frame for use is considered to be quite long. And so this is an example of some of those ratios. So you'll see here the L income fund is again 74% in G, and the rest is spread out. Versus the L 2050 fund, only 11% is in G, and you've got much higher percentages in the C, S, and I. So again, close to retirement, is much more conservative. Uh, Far out from retirement is much more aggressive. Now, what happens is the L 2025 fund next year, when we hit 2025, will become the L income fund. So as that year becomes the present year, they all roll into this bucket and they all stay in this basic allocation. And the reason for that is that um, these are mirroring indexes, and BlackRock is very passively managing this money, meaning you can't call up BlackRock and get investment advice. That's not their job. Their job is just to manage the funny money. They're not designed to manage it to you. And so when you get to retirement age, BlackRock has basically said that strategies in retirement, because you're generally distributing the money and taking it to use for your retirement, your strategies there should be different than your accumulation phase of life. So because they're not giving you investment advice, they don't have options designed around a distribution phase of life. So that's why they dump everything into the L income fund. Majority of people at retirement, some of them even before retirement, will roll their money from TSP into an IRA to then design their retirement strategy of investing. So in the IRA world, there are tens of thousands of options, and you can really customize those options to whatever your goals are. Um, Again, don't want to give you investment advice. It's definitely something that you want to meet with us on a one-to-one basis, or meet with your financial planner if you have one. But meet with somebody. I heavily encourage a retirement plan, because there's a lot of strategy that can go into this, both from an income standpoint, making sure that your money lasts, and as well as taking taxes into consideration. So TSP, number of years back, was getting a lot of heat from unions and participants that there weren't many investment choices in here. And so TSP decided to cave a little bit and created what they called the mutual fund window. It was launched in June of 2022. And what they said is, hey, we're going to open up these windows from time to time. In which case, when you open the window, you'll have thousands of mutual fund choices that you can, pick from. Um, However, uh, this was not really what the government wanted to do. TSP didn't really want to provide this for you, but they kind of, like I said, they caved to do it. So they made it insanely difficult and costly to do so. So if you elect to take advantage of the window and invest outside of it, first off, they're going to charge you a $150 annual administration fee for having that window open for you. They're then going to charge you $28.75 for each transaction in that window. So again, that's adding some expenses. And then when you're picking mutual funds from this window, be aware that each of those mutual funds are going to have expense ratios, and those expense ratios are going to be higher than what's in TSP. The TSP core funds are the lowest cost investment options in the marketplace. I mean, they are cheaper than any 401k or 403b that you'll find, and they're generally going to be cheaper than any mutual fund that you'll find. So there are some other limits in here. So when you go to take advantage of this window, your investment in that outside fund has to be at least $10,000, and it cannot exceed 25% of your account balance. So if you kind of reverse that math, you have to have at least $40,000 in your TSP account to even take advantage of the window, because 25% of that 40 is that $10,000. Now, interfund transfers. So again, this is back to those core TSP investments. You can move money between the different funds 2 times a month. You can move your money to the G fund anytime you want to. So even if it's in excess of two, even if you've already made 2 trades that month, you can still go to G fund for safety if you want. However, TSP does not allow for day trading. So and they've kind of designed stop safety measures in here to prevent day trading. So what I mean by that is that when you go in to make a change, you can see if your request is made by 11 a.m. Central Time, it says they'll go through on the same day. The request to make the trade will go through the same day, but the trade will actually still take an extra day. So think 2 days from the time you go in and say you want to change from one fund to another, it's going to take 2 days for that to fully take effect. So your ability to take advantage of same day market movement does not exist anymore. So if you see the market dropping and you're trying to avoid it, you could prepare to avoid future losses, but you're not going to be able to miss out on that day's activity. I mentioned this earlier, but the fees for TSP runs 38 cents per $1,000, or 0.038%. Again, it is lower than just about anything else you will find in the investment world. And so the reason those fees are so low is the federal government went to bat when they went to BlackRock and they said, "Hey, we're going to create this. We're going to put this money with you guys exclusively, but we want in exchange to be very, very low cost to the employees." So TSP is the largest 401k essentially in the world. These are private funds that are created that BlackRock created for you guys. And because again, it's passive management, most of the stuff in TSP is done by computers. It's very cheap to administer for them. Again, why they don't allow day trading and why you can call in and they'll help you with your account, but they won't give you investment advice at all because they don't have a big staff. For one, and they don't want the liability of giving out or acting in a fiduciary capacity. So that's why it's really cheap. You can take loans against your TSP. So TSP, you have to have at least $1,000 in contributions and earnings. You cannot have taken another loan in the last 60 days, and you cannot have defaulted on a TSP loan in the last 12 months. Um, there are two types of TSP loans. The first type is what they call a general purpose loan. This is anything you want to use it for. You don't have to document it or anything like that. However, it generally has to be repaid usually within a 5-year window. And so when you set up the loan, you'll kind of elect what payback period you want. Like if you want 3 years, 2 years, 5 years, that kind of thing. And it's with the payback is withheld out of your paycheck. Uh, the second option is what they call a special primary residence loan. And so you can repay this one over a period of 15 years if you want. You do have to submit documentation to it. And then if you were married, you're going to need a spouse to sign off on the loan request. Now, keep in mind, you can have a loan and be paying back a loan and still contribute to TSP at the same time. They'll be listed as two separate things on your pay stub. The loan amount limits are the lesser of half of your account balance or $50,000. So keep that in mind too. And essentially, what happens is the remaining balance in your account is serves as collateral for the loan. And so the loans can be requested right on the TSP website, or you can call in and request one. A couple of different ways you can go about it. I don't particularly recommend these because when you take out a loan from TSP, you're essentially borrowing from yourself, and when you do that, while it may be strategic interest rate or a lower interest rate, you're not getting growth on that money in your retirement account anymore. So the cost of the loan isn't just the interest you're paying, it's the opportunity cost of what you could have made in the money. You're also slowing up your retirement savings. So don't misunderstand. I'm not saying that nobody should ever take one. There are certainly cases where this is a good option. If maybe another loan isn't available to you, um, then yes, it's better than nothing. I mentioned this earlier that the loan interest rates follow the G fund rate. So again, it's not overly expensive. You're again borrowing it from yourself, and it can be done through payroll deduction. One thing to be aware of with these is that if you retire and you have an outstanding loan, you they will allow you, if you're quick about it before as you retire, they will allow you to set up a bank account to continue making the payments out of. If you don't do that, then the loan will basically be defaulted, and all of that loan will get treated as income to you in that year, which is going to be taxable. And if you're under 59 and a half and or not retired, it could have a penalty tax as well. There are hardship withdrawals here. Hardship withdrawals just allow you that if you're under 59 and a half and working and you're trying to get some money out of this for a hardship, you need to submit documentation for it to qualify for the hardship, and that's to avoid a 10% penalty. You do still pay taxes, so they will withhold 20% in tax, but they won't withhold the 10% penalty, which you're mainly going to need when you go to do your tax filings for the IRS at the end of the year. If you do take a hardship withdrawal, they won't allow you to contribute to TSP for at least 6 months. So keep that in mind. Now, if you're working, uh, there is what's called an in-service age-based withdrawal. So if you're working and you're 59 and a half or older, you can do up to 4 withdrawals per year. and there's no ban for contributing or anything like that. What this allows you to do is you can take money out and roll over the assets to another IRA to work on your retirement strategy if you want. Rolling pre-tax money, so regular TSP to a traditional IRA is not a taxable event, so it moves with no taxes, right? Moves laterally right over. Same thing if you're in the Roth TSP, you can also roll Roth TSP to a Roth IRA. So again, there's advantages to doing that for long-term, planning or retirement planning needs. But you definitely want to talk to somebody about that if that's a consideration for you. Um, TSP is a little restrictive on certain aspects of legacy planning and distribution planning. So that's why they allow this. Options at retirement or separation from service. So there's three kind of main options here. The first one is a lump sum cash out. So this is like taking everything, right? Uh, you, there's two ways you can do it. You could roll it to an IRA, um, and in which case there's no taxes because again it's pre-tax to pre-tax or Roth to Roth. However, if you take the money and have it distributed out to your checking or savings account, well, you're going to pay tax. This is a bad idea, to be quite honest with you, unless you have a small TSP. They're going to withhold 20% automatically. However, that is going to be treated or taxed as earned income at the end of the year for you. So if your tax bracket is already high, this is going to push it quite a bit higher. And if you are like most federal employees and have a couple $100,000 in here or more, you're probably going to be paying 30-35% in taxes on that money. Um, I don't see that done very often. The only times I've ever run across it is occasionally I'll get someone who says, "Hey, when I retire, I want to take my TSP money and I want to pay off my mortgage, so I'm not going into retirement with a mortgage." I certainly understand that there's a peace of mind aspect to that planning, idea, but you don't want to do that because of that tax I just mentioned. So if that is your plan, definitely talk to us, talk to your financial planner. There are other ways to sort of tackle that same goal without Uncle Sam getting a third of your TSP. So keep that in mind. Option two here is a fixed dollar amount. So TSP does allow you to set up monthly, quarterly, or annual distributions. You can change those up or down as needed. Um, this is not to be confused with option three that we'll go with here. This is just you saying, "Hey, send me $500 a month, or $1,000 a month, or $5,000 a quarter, or whatever." Right? You can set that up. TSP will send that out. Option three is there is a what's called a TSP annuity. Now, a lot of you may have kind of seen this advertised. They've started printing like a little cover page to your statement, your TSP statement now that talks about how much money you could receive each month in retirement with the TSP annuity. Um, be careful. The TSP annuity is not actually run by TSP. It is a partnership with MetLife. MetLife is the exclusive provider of the TSP annuity option, and as such, they give you the worst annuity option that MetLife offers. Now, it isn't that it's an annuity that is the part that's scary. What the TSP annuity requires you to do is to do what's called annuitize the money. And so what that means is that you inherently are giving your money to MetLife. It is now MetLife's money. In exchange, MetLife gives you a promise of a payment for the rest of your life. You can even, there is a spousal option, so you could set it up just to pay for you and your spouse's lives, right? And they will guarantee that payment, which is very attractive. However, let's say you choose spouse with and a joint, like you and your spouse, and you and your spouse are 6 months into retirement and you're killed in a car wreck. That has actually happened to my grandparents. So if you're killed in a car wreck and you had elected that option, it's not going to, the leftover money is not going to go to your kids. It is going to be kept by MetLife. It is now their money. And so for that reason, I never recommend anyone to pick this choice, right? I don't really care what your particular situation is. There are better options for you. Please, if this is attractive to you, you're thinking about this, talk to us, talk to a financial planner. Um, you can get the same or higher payouts in the open marketplace without ever having to give up control of your money. So, um, if that was a thought, I encourage you to definitely explore your other options. This is basically what I just said. MetLife, they own it, they control it. no cash value upon death, and all that income could stop depending on which option you picked. Now, spousal rights to TSP account balances, right? If you are married, then anytime you go to distribute money from your TSP, your spouse is going to need to sign off on that distribution. The next topic here is required minimum distributions. So this comes into play. I hear, from time to time, somebody will say, "Hey, I don't necessarily need TSP to be an income source for me in retirement. I really want to just leave it either for my spouse or kids when I pass away." Well, you can. However, there is what's called an RMD. And so what this means is that if your money is in the TSP traditional, the pre-tax side, the IRS essentially says, "Hey, we've let you grow this money for quite a period of time, tax deferred. It's our turn to get a little piece." And so depending on what year you were born, you'll that's when your RMD is going to trigger. So you can see if you were born before July 1st of 1949, your age is 70 and a half. If you're July 1st of 49 to 12/31 of 50, your age is 72. If you're January 1st of 51 to December 31st of 59, your age is 73. And if you were born 1960 or later, your age is 75. Now, for all intents and purposes, just think that when you hit that age, you're going to need to take out somewhere between 4 and 5% of your prior year end account balance. And by take it out, I mean receiving it in your checking or savings account so that it can be taxed, and those taxes can be paid to the IRS. If you do not do this, the IRS is going to penalize you and force you to take it out anyway. So the penalty has always been 50%. They recently made some exceptions that it's down to 25% in a lot of cases, but you don't want to pay a 25% penalty on top of taxes on money that they're requiring you to take out. So I didn't know won't be accepted as an answer by the IRS because you will get plenty of notices to pull this out before this time comes up for you. Now, TSP at the death of the participant. This is where I say that legacy planning, estate planning, you definitely want to work with us or somebody like us to lay this out, because if you leave your money to your spouse, that's perfectly fine. In TSP, it will go to your spouse. Your spouse can then uh, take the money out as needed, treat it like their own TSP. However, when they pass on, their beneficiary is going to have to take the money out immediately. They don't get to stretch it out over 10 years like an IRA would allow. So it's a little bit of a weird quirk with TSP, but if the goal is to eventually get it to the kids, but keep a spouse in there just in case, that it's not a good strategy because your kids are going to have to take it all out at one time, and they're going to pay taxes at probably a relatively high tax bracket. And so there's much better ways to tackle that in the IRA world. If you don't have a beneficiary listed on your TSP, the balances are going to be paid out according to the standard order of precedence rules. Some closing TSP comments here. You do not, don't misunderstand, you do not need to close out your TSP account. You can certainly leave it in there. Just know that there are some stipulations and things about it. You should definitely, have a retirement plan for yourself. Uh, Keep in mind how taxes are going to come into play in retirement. And then, if you're, again, in your working career, TSP is a great savings vehicle during those accumulation years. You'll just see, but it's not necessarily the best income vehicle. So, in closing here, your estate plan, retirement income plan, if you don't have one of these in place, we do offer the ability to do a one-to-one meeting with you. When we do that, we will cover retirement income projections, survivorship income, Social Security benefits timing, risk tolerance or risk aversion for you, taxes, ways to reduce taxes, health insurance in retirement, and legacy planning. This is all part of it. There's no cost or obligation to it. We run all this for you guys at no cost, and we'll give you a nice, clear picture of exactly what retirement's going to look like for you. So if that is something that you haven't done, or you don't have a financial advisor to do this for you, again, let us know. Feel free to reach out. We can be reached. Here's my email, our website, and then this is actually our calendar. So you can go right to this calendly.com uh, /PDRP and literally book any day, time that works for your schedule. We will be happy to meet with you. It is a couple meeting process. The first one is to figure out what your goals and objectives are, where you are now. Then we put all that documentation together into the plan for you, all the estimates we run for you. And then we get back together a second time on a Zoom meeting, go over everything line by line and give you a nice, clear understanding of how everything's going to work and make sure it hits that retirement you have in mind. All right. Well, again, thank you for tuning in today. Feel free to reach out with any questions you may have, and good luck in retirement.